Hi there, and welcome back to the O.B.S Financial Educational Series, Learn from the Tax Masters. My name is Stacey Bartel, and I'm president of O.B.S Financial. And today, we're going to talk about the RRSP deadline. Right? Yesterday, we talked about T4, T5 deadlines. Well, there's another deadline today, and that's March 1st. That is the last day that you are able to contribute to RRSPs. Now, March 1st is not a fixed date. RRSP contribution season actually goes the first 60 days of this year is reported and claimed, or is reported on last year's taxes. Now, why is the 60 days important? Well, if there's a leap year, the 60th day lands on February 29th. Next year, March, right, 2019, no, this is 2019, 2020, March 1st lands on a Saturday. With March 1st landing on a Saturday, financial institutions are closed, so they extend the deadline and it'll be March 3rd at midnight, which will be your RRSP deadline. So you always want to pay attention to the RRSP deadlines. You normally get an extra day or so to file or to make an RRSP contribution. Okay? What we're going to talk about right now is the changes or the enforcement that CRA has been putting on the first 60 days of RRSP contributions and how they're actually affected. So, in the age of computerization, the Canada Revenue Agency is all about deadlines. About 3 years ago, they decided to, draw a line in the sand regarding when you had to report your RRSP contributions. Okay? And they're enforcing the first 60 days rule of it is a previous year's tax deduction. Okay? So there's actually 2 RRSP buying seasons in a calendar year. There's the first 60 days, which is January 1st to March 1st normally, and then the remainder of the year, March 2nd to December 31st. Now, the RRSP season runs 60 days later than the calendar year. So, try to explain this. You purchase RRSPs March 2nd from last year. Let's say that you're in an RRSP, let's say you do regular payroll deductions, or you get money taken out of your paycheck every 2 weeks to go into your RRSP. So we're going to use $100 because I like round numbers. So $100 every 2 weeks gets deposited and put into your RRSP. 26 paychecks a year, $2,600 gets reported. Well, you're going to get a minimum of 2, sometimes 5 RRSP contribution receipts for that if it's bi-weekly, depending on the financial institution that you deal with. So anything from day 61, March 2nd, to December 31st of 2018 will be lumped together and put on one RRSP slip, which you should have already received from the bank, probably sometime January, early February. That would show that for the 22 pay periods that you had in that time frame, you put $2,200 into your RRSPs. Now, January you had 2 paychecks, February you had 2 paychecks. With those 4 paychecks that you received, you put another $400 in. You're going to get additional RRSP contribution receipts. Now, some banks send you out 1 every time you deposit. So you'd get 1 for the middle of January, 1 for the end of January, 1 for the middle of February, 1 for the second paycheck in February, 4 receipts. If you get paid weekly and you're doing $50 a week, you're going to get 8 or 9, depending on whether you get paid on Thursdays or Fridays. Right? So important to understand that there's multiple receipts that you're going to get over the next couple of weeks that have to be reported on 2018's tax return. Okay? Why do they have you report things on 2018? Right? When I'm buying it in 2019. Well, because we're computerized, Revenue Canada has what's called a matching department. That matching department, or step back a bit, when you file your taxes, you file them electronically, Revenue Canada will pay you within 8 days, or as quick as 8 days. In that time period, they don't have time to wait to see what other tax forms are in, and they don't do an in-depth audit of your tax return. They do a cursory look. They sit back and they say, okay, based off the income that you reported, does it match the income that they have in T4s, T5s, right, that they've already received on file? If the income you reported is equal to or greater than, they process the tax return because they don't know any better, right? Now, in September, October, when summer's done, they open up what's called the matching department. The matching department runs their computer systems and they compare every tax return in Canada to take a look and see now that they have all their tax forms on file, they take a look and see, is all of your income correct, right? Did you misfile any of your T4s or T5s or T3s or anything else? Your RSP contributions, did you deduct more RSPs than what you actually put in? Now remember, Revenue Canada will not correct if you don't claim all of your deductions. They will only correct if you don't claim all of your income. So if you had RSP contributions that you neglected to claim or report on your tax return, they're not going to say boo. They're going to say, hey, you know what? He doesn't want to worry about it. We're not going to worry about it. It's only the income. So they check to make sure, okay, well, you know what? Last year they put $2,200 into RSPs. This year they put $400 in the first 2 weeks. They had $2,600 in total. They claimed $2,600. Perfect. There's no problems. Now, what happens if you missed one slip from last year and you claimed $2,200 for the remainder of the year, 2018, $400 for the first 60 days of 2019, and $200 for the first 60 days of 2018. You're going to have claimed $2,800 worth of contributions, but their system's going to say 26. Well, guess what? They're going to kick out a notice of reassessment. They're going to send you a bill for the difference that extra $200. They're going to take away that $200 in RSP contributions. They're going to charge the difference in tax plus interest. Now, when you receive that, you now have a couple of things to do. You can go back to your 2017 tax return, adjust it, include that $200, and either claim it in 2017 or claim it in 2018. With RSPs, and I should have mentioned this earlier, with RSPs, there's a difference between reporting and claiming. You have to report the contributions in the year that you reported them. But with RSPs, you don't have to claim them in the year that you contributed, only report them. So they actually allow you to carry over some, all, or none of your RSP contributions. So where does that happen? Well, normally where it would happen is somebody comes into some money. They have an inheritance, they win some money, they get a buyback from their employer, or they quit their job and they get a retirement allowance. They get that money in January and February. They want to put it away for their retirement. They don't want to pay tax on it right now. They go and they buy an RSP for $20,000, $25,000. Coming to see your tax guy, well, you know what? I'm focused on making sure that you're getting the best return off those RSPs based off your tax brackets. So if claiming $10,000 is more benefit, claiming $10,000 this year and claiming $10,000 next year will get you more back on your income tax returns than claiming $20,000 this year, we're going to look at the option and factor in time value of money and see which is the best way to do it. So I've had cases where clients have come into an inheritance, put $60,000 into their RSP because their banker told them to do that, and it took us 8 years to properly claim that. But at 5 to 10% difference in the income tax return versus the investment earnings that 5 to 10% or that 5 to 10% tax difference would have made, it makes more sense to hold on to it. So RSPs can be claimed down the road, but they have to be reported this year. Hopefully that explains it. I just want to make sure that everybody understands, if you really want to make sure that your RSPs are taken care of, wait the time, understand what your contributions are. If it's payroll deductions, make sure that you're looking at your pay stubs. Make sure that you're getting all of your RSP receipts before you come in. It can be a costly mistake to hold off to it because Revenue Canada will make you go back, do adjustments, reassessments. That's going to cost you money, or they're going to charge, or they're not going to, worst case scenario, you leave it alone and they're not going to give you a tax deduction on that RSP. But when you take it out, they're going to charge you tax on it again. So now you're being double taxed. Anyways, I hope that explains RSPs. If you have any questions, make sure you check with your tax advisor. We're taking appointments right now, so if you need any help, you can always give us a call. Starting next week, it's going to be really busy. Anyways, that's the end of this week's edition. We will see you all on Monday. Thank you.